Welcome to the Deep Dive. You give us the sources, we pull out the key insights, and give you that knowledge shortcut. Today we're digging into McKesson Corporation, specifically their Q2 fiscal 2026 results, and honestly the headlines are pretty staggering.
Oh, they really are. I mean, you're looking at consolidated revenues hitting a record $103 billion. That's up 10% year over year, which is solid. But for me,
Yeah.
the number that really jumps out, the one that signals something bigger is happening, is the adjusted earnings per diluted share. It surged 39% to $9.86. That kind of jump, that bottom line acceleration, well, it doesn't just happen by accident.
No, absolutely not. It points to some kind of major shift going on under the hood. So our mission today is really to get past those big top-line numbers and figure out what engine or maybe engines are driving this momentum. And this deep dive feels crucial right now because McKesson literally just reorganized its reporting into 4 new segments.
Yeah.
Exactly. And that new structure, it's basically their strategic roadmap laid out for everyone to see. It tells you very clearly where they're pivoting. The core strategy seems laser-focused on accelerating growth in 2 key areas, oncology and multispecialty, O&M, and biopharma,
Right.
while also, shoring up their traditional North American distribution base and really modernizing the whole portfolio. Think technology, think targeted acquisitions.
So it sounds like they're deliberately pruning some of the maybe slower growth areas to really double down on these high-margin specialty areas and digital services. Let's start with the obvious star in that new lineup.
Yeah.
Oncology and multispecialty, or O&M, as you said. This segment isn't just growing, it feels like it's exploding.
Explosion is, probably the right word. O&M revenues leaped an amazing 32% to $12 billion. But here's the number that really changes the game. Operating profit in O&M didn't just grow, it surged 71% to $397 million, just in the quarter.
71% profit growth in 3 months. That's extraordinary. That's not just like more volume going through the system. That kind of profit leap suggests either some kind of crazy operating leverage or maybe more likely a fundamentally different, much higher margin business being bolted on. Which is it?
It's definitely the latter. It's heavily driven by a couple of key acquisitions they made just in the first half of this fiscal year. See, McKesson isn't just distributing expensive specialty drugs anymore. They're actually buying the infrastructure that supports the doctors and clinics prescribing them.
Okay, unpack those acquisitions for us. What did they buy?
So 2 main ones driving this. First, PRISM Vision. They bought that back in April 2025 for about $871 million. It provides administrative services for ophthalmology and retina practices.
Okay, eye doctors.
Right. And then the bigger one, Core Ventures, acquired in June 2025 for a hefty $2.5 billion. Core provides administrative services for major oncology groups, including really influential ones like Florida Cancer Specialists.
Wow. So they're buying the back office plumbing, the administrative engine for these specialized medical groups. And what's really interesting is how much financial impact those deals are already having.
Exactly. Get this. The acquisitions together only contributed about 12% to O&M's revenue growth in Q2, but, and this is the key part, they're expected to contribute between 30% and 34% of the segment's operating profit growth for the entire fiscal year.
Okay, hold on. Small slice of revenue growth, but a massive chunk of the profit growth.
Precisely. Think about that gap. It confirms they weren't buying volume, they were buying margin. They were buying essentially control over critical parts of the provider network infrastructure.
That really tells the story, doesn't it? McKesson's capital is clearly aimed at, well, vertical integration within that high-value specialty medicine space.
Absolutely. The business model they seem to be building is less about just moving drugs with thin margins and more about providing these essential sticky business services that kind of lock those specialty providers into the McKesson ecosystem.
All right, let's shift gears slightly. There's another powerful trend that seems to be boosting growth across multiple segments, not just O&M. I'm talking about the GLP-1 medications, the popular weight loss and diabetes drugs.
Oh, yeah, the GLP-1 phenomenon. It's definitely driving significant volume through the whole system. If you start with their core segment, North American Pharmaceutical Distribution.
Right, the traditional business.
That segment saw revenues climb 8% overall, largely just from higher drug utilization. But within that, GLP-1 revenue alone was $13.2 billion in this quarter. That's a huge 24% increase compared to last year. Just sheer volume pumping through the main distribution channel.
Okay, that makes sense for the distribution side, more drugs moving. But where it gets strategically really interesting is how the demand for these drugs affects their highest margin segment. Prescription Technology Solutions, or RxTS, that segment doesn't actually touch the physical drugs, right?
You nailed it. That's the critical nuance here. The growth in RxTS isn't about volume of pills. It's driven by the complexity involved in actually getting access to these kinds of medications. When a new, super popular, often high-cost drug class like GLP-1s takes off.
The insurance companies, the payers, they put up
Yeah.
hurdles, right? Prior authorizations, checks.
Exactly. Barriers go up immediately, and that's where RxTS comes in. They manage those hurdles for the patient, for the doctor, for the pharmacy. Their operating profit jumped a very healthy 19%, almost entirely because of higher demand for these access solutions, the admin services, the prior auth tools, all tied back to this GLP-1 wave. It's McKesson selling valuable data processing and services, not physical goods.
And the financial profile just screams different business model. We know distribution margins are usually razor thin, low single digits maybe. What was the operating profit margin for RxTS this quarter?
It was 17.73%.
17.7%.
Yeah. Compare that to, like you said, low single digits for core distribution. RxTS is operating at nearly 18% margin. It looks much more like a tech or services company than a logistics company. So this GLP-1 wave is kind of the perfect example of a tide lifting two very different boats, high volume through distribution and high margin services through the tech platform.
Okay, so while the volume is strong in North American pharma, we do need to talk about a pretty significant headwind that segment took on the chin. Even though core operating profit was still up a decent 13%, there was a big drag in the overall numbers.
Yes, and it's kind of a stark reminder of the risks you run in that core distribution model, especially reliance on just a few massive customers. In the first 6 months of this fiscal year, McKesson had to record a provision for bad debts totaling $189 million.
Ouch.
And it's all related to the bankruptcy of one major customer, Rite Aid.
That's a big hit to absorb.
It really is, especially when you contrast it with the same period last year where they actually booked a credit related to Rite Aid because the situation was unfolding differently back then. So that swing from getting money back to taking a nearly $200 million charge, it introduces a lot of noise, a lot of volatility. Even if the underlying drug use and volumes from their other big retail customers were strong, it just underscores why they're so focused on diversifying towards businesses like O&M and RxTS that are less exposed to single customer risk.
That flows perfectly into the second major part of their strategy, simplification.
McKesson seems to be getting really clear about what it is and maybe just as importantly, what it's not going to be. And the Medical Surgical Solutions segment looks like it's on the not list. It's definitely the odd one out in the new strategic story they're telling. Revenue in MedSurg was basically flat year over year. Operating profit only edged up about 2% in Q2. They also specifically called out about a 4% revenue headwind because of lower sales of things like seasonal vaccines and COVID tests compared to the peaks we saw before. I mean, it's a steady business, sure, it's necessary, but it just doesn't fit that high-growth specialty profile they're building elsewhere.
So the answer is a strategic separation. Clean break. Make the remaining portfolio story clearer for investors. They're actually planning to spin off Medical Surgical entirely.
That's the plan. An IPO first, then followed by either a spin-off or a split-off transaction. They're targeting completion sometime in the second half of calendar 2027. And you combine that move with other divestitures they've been making internationally, like they fully exited their Canadian distribution business, and the Norway business was just classified as held for sale back in August. It shows a real commitment to shedding anything that's not core. The goal seems to be a leaner, faster-growing company focused purely on specialty pharma, biopharma services, and technology.
In this disciplined execution, it's not just about buying and selling businesses, it's actually showing up in their core operations too, right? The sources mentioned a big improvement in operating leverage, driven by what they called a technology-first mindset.
Yeah, this is sort of the quiet success story behind the headlines. It's the payoff from investments they started making years ago. Get this. Operating expenses as a percentage of gross profit. It declined by 570 basis points.
Whoa, 570 basis points. Just translate that quickly. What does that mean in simple terms?
It means they got way, way more efficient at converting their gross profit dollars into actual operating profit. For every dollar of gross profit they generated, they spent about 5.7 cents less on overhead and running the business compared to before. Some of that's cost-cutting, sure, but they're saying a lot of it comes from those big investments in warehouse automation and digital tech finally hitting their stride, really coming online at scale now. And that efficiency gain is a big reason why they felt comfortable raising their earnings guidance for the full year.
Right, let's talk about that guidance and the overall financial picture. McKesson bumped up its full-year FY26 earnings forecast to between $38, $35, and $38.85 per share. That signals pretty deep confidence that this specialty-driven growth is sustainable.
Definitely. And they're backing it up with how they're using their cash. They're projecting really strong free cash flow for the full year, somewhere between $4.4 billion and $4.8 billion.
That's a lot of cash.
It is. And they plan to use a good chunk of it, about $2.5 billion, to buy back their own shares. That's a pretty aggressive return of capital to shareholders. Plus, they raised their quarterly dividend back in July to $0.82 a share. So it suggests they feel financially solid enough to fund growth, return cash, and handle their existing liabilities all at the same time.
And speaking of funding growth, we should probably mention that big Core Ventures acquisition, the $2.5 billion one, was partly paid for with new debt, right?
Yeah.
A $2 billion offering.
That's right. Debt specifically raised and strategically deployed to buy a core piece of that new high-growth specialty platform. It wasn't just borrowing for borrowing's sake.
Okay. And the look at the financials complete without touching on the big legal issue.
Yeah.
The opioid settlements. Where do things stand there?
Right, the main litigation overhang. So the company's total estimated accrued liability, basically, the money set aside for all the major opioid claims, that includes the big settlements with governments, tribes, and some non-government plaintiffs, stood at $5.72 billion as of the end of September 2025.
And how does that compare to before? Is it going up or down?
It's actually trending down. It was higher around $6.377 billion back at the end of March 2025. So they're actively managing it down. We know they made payments totaling $497 million just in the first 6 months of this fiscal year related to those settlements. So significant cash is going out the door to meet those obligations.
But the legal risk isn't completely gone, is it?
No, not entirely. It's definitely important to remember that McKesson is still fighting hundreds of other opioid-related lawsuits. These are mostly private, non-governmental cases that weren't covered by those big global settlements. So, while the massive liability from the main settlements is accounted for and being paid down, there's still ongoing legal defense work and potential exposure from these other cases.
Okay. So if we kind of zoom out now and look at the whole picture, what's the clear strategic takeaway for you, the listener, from this deep dive? It really seems like McKesson is executing a very sharp two-part strategy.
Absolutely. I think the success story here is driven by, one, hitting the accelerator on those two high-growth, high-margin platforms, Oncology, Multispecialty, and the RxTS tech services, and two, at the exact same time, simplifying everything else, getting rid of distractions through things like the medical surgical spinoff, the Norway sale. They're fundamentally trying to change the company's DNA, moving further away from just being a massive volume distributor.
Yeah, it feels like the company is really betting its future on specialty medicine and, maybe more importantly, the value they can capture from handling complex data and processes, not just moving physical boxes around.
It's really the evolution of a giant, isn't it? They're using their existing scale and distribution muscle as leverage to climb further up the healthcare value chain, embedding themselves into these administrative and technology services where the margins are just dramatically better.
Which brings us nicely to our final provocative thought for you to chew on. McKesson seems to be proving that sheer scale isn't the only game in town anymore for healthcare distribution. The new competitive frontier looks like it's shifting towards services. So the question is, how will this growing focus on high-margin tech platforms and specialized services, like we see with RxTS and O&M, fundamentally reshape the entire industry? Will it force competitors to also move away from their traditional high-volume, low-margin routes? That tension scale versus services, that feels like the core strategic dynamic to watch in this whole sector over the next few years.